Portfolio. You guys have heard of like an art portfolio? Yeah, art portfolios. Okay, your art portfolio is basically all of the art you've ever created. You know, photographers have portfolios of their photos to show people. Well, your stock portfolio is all of your stock that you own. And you can have a very limited portfolio. Perhaps you only own stock in one company, or you can have a very diverse portfolio where you own stock in multiple companies and maybe in commodities, bonds, things like that. Okay, the difference between a stock and a commodity, really quickly. A stock is a part of an ownership in a company, corporation. Commodities are physical items that carry value. Gold, you've heard about like the price of gold goes up, and silver, and orange juice, and pork bellies, and those are commodities. They're real, tangible things, either like minerals or agricultural products that you can trade. And the value of the commodity goes up or down depending on the value of the actual item. For example, if there's a freeze in Florida and you own orange juice commodities, then there's a shortage of oranges and the price of orange juice is going to go up. So your value of your commodities goes up. Okay, so the rarer things are, the more valuable the commodity is. And then bonds are, it's not ownership in a company, but a bond is you loaning money to a company or to the government. There's corporate bonds and there's governmental bonds. And basically, if you, let's say I buy $100 corporate bond, I'm loaning the corporation $100, and then after the term of however many years is set on the bond, I get that money back plus interest. Okay, so your portfolio includes all of that. Your trade is the stock being bought and sold. Stocks don't just like hang out at the mall on the shelf waiting for somebody to buy them. Somebody owns the stocks. Either the company itself still owns their own stocks until they've all sold, or some other human being somewhere owns the stocks. Anytime the stock is being bought and sold, it's being traded. So when I buy stock, somebody else has to be willing to sell it. So they have to sell the stock. I can't just continue to buy stock if nobody's wanting to sell. If everybody's holding on to theirs, I can't buy it. So people have to be, it's a trade. It's an even trade. Stock is bought and sold in lots. There are rounded lots and odd lots. Rounded lots are multiples of 100, and odd lots are less than 100. So if you buy 60 shares of stock, you've bought an odd lot. If you buy 160 shares of stock, you bought one rounded lot of 100 and one odd lot of 60. If you buy like 560, you've got 5 rounded lots and 1 odd lot. That's just how they work it. So they always go by groups of 100. Questions on that so far? Capital gain and gross capital loss. Okay, have you guys heard the difference between like gross and net? You know, when you talk about your income, your gross salary is how much you actually earned, and your net salary is how much you actually get to take home. Well, it's the same thing with a gross capital gain or a gross loss. The gross gain or the gross loss is just based on the value of the stock. It doesn't take into account taxes or brokerage fees or anything like that. It's just the difference in the price of the stock. So your gross capital gain, you have a gain if you sell the stock for more than you bought it for. And obviously this is the goal. You want to gain. You always want to gain. You never want a loss. And the loss is what happens if the stock is sold for less than you bought it for. And the reason it's the gross, again, is because you don't take into account any kind of taxes that you may have to pay for any gains, and you don't take into account any kind of brokerage fees that you had to pay, which we're going to talk about those in a little while too. All right, so when we want to calculate capital loss or capital gain, Marlene purchased stock for $7,241. She sells the stock for $9,219. She sold it for more than she bought it for, so she has a gain. And it's just subtraction. You don't have to do any percentages or division or anything weird. You just subtract how much did you sell it for minus how much did you buy it for, and you have your gain. Now, if you always do the sold price minus the buy price, you'll get your loss or your gain. If it's negative, you'll know it's a loss, and if it's positive, you know it's a gain. Although, probably you can figure out loss or gain without even needing to know if it's positive or negative, right? If it's less than you bought it for, you lost money. 5 years ago, Jessica bought 300 shares of a cosmetics company for $34.87 per share, and yesterday she sold it for $41 per share. Now, if we just take $41 minus $34.87, we know the capital gain for that individual share of stock, but we won't know her gross capital gain for everything. So there's two ways you can do this. You can do 300 times $34.87 and 300 times $41 and then subtract. So that's the first method. Or method 2, you can do $41 minus $34.87 and then multiply times 300. So there's two ways to approach this problem, and you can do the one that makes sense to you. I'm going to do method 2 because it's smaller numbers, but you can do either one. So I'm going to do 41 minus 34.87, and that gives me $613 each, but she had 300 of them, so that gives her a gross capital gain of $18.39. Okay. If I had done it the other way, I'm going to get the same answer. So this is method 1, this is method 2. Do either one. This is one of those problems you can do either way, and it just whatever makes this more sense to you. If we come back to capital gain really quickly and capital loss, either one of these could be money or a percent. That's how you can express it. So you can have I had a $50 capital gain, or I had a 20% capital gain. Just same thing. Now to do the percent capital gain, percent change, it's going to be the same thing, that new minus original divided by the original. I think I talked about that already, didn't I? So his new price is the selling price. That's the current day. So $6,100. The old price is what he bought it for, or the original, and that's also what I divide by. So I'm going to get 6,100 minus 3,450. Divide that by 3,450. Okay, and I'm rounding it to the nearest tenth of a percent. So I need to move this 2 places over to make it a percent. And that 1 is not going to change the 8. So it's 76.8% capital gain. If you had a capital loss, this would be a negative number. And so it would be a negative percentage, and that's okay. That just indicates that it's a loss. You don't have to write it as a negative percent. You can just say, for example, if it was a 76%, you'd say 76% loss. Or you could say negative 76%. Either one is the same. Okay, so the stockbroker is a person, or it can be an organization, that is licensed to buy and sell stock. So while you and I can buy stock or sell stock, we can't just call up the stock market, you know, the New York Stock Exchange, and be like, oh yeah, I'd like to sell my 20 shares of Target. It doesn't work that way. You have to go through an organization or through a stockbroker that's licensed to make those transactions. And of course, because that's their job, they're going to charge you for it. That's how they make their money. Stockbrokers make money off of your buying and selling of stock. Now, the fee that's charged is called the broker fee, and it can be a flat fee. So like maybe they charge $10 per trade, regardless of what the trade is, or it can be a percentage of the value of the trade, or it can be a combination of the two, like a $5 plus 3%, or something like that. The commission is the fee based off the percent of the sale. That's called the commission. Now you have discount brokers. Discount brokers, the fees are much, much lower, but they only buy and sell as you tell them to. They're not allowed to offer you advice. If you want financial advice, you need to go to a financial planner. The discount brokers are like E-Trade. You've seen the commercials for E-Trade. Any website that you just go online and you buy stock or sell stock and you don't talk to an actual person, that's a discount broker. There's some discount brokers that you can actually call up and talk to a person, but you just say, yeah, I want to buy, you know, Petco or whatever, and they say, okay, cool. But they can't say, oh, you know, even if they know for a fact, like, oh, Petco's going under, they're going bankrupt, they just apply, you know, they can't tell you. They're not allowed to give you advice. They just have to do what you say. And that's why they charge such low fees, because they're like a cashier. They're just processing the transaction. Any questions on that? Okay, so if you call up your stockbroker and you say, I want you to buy Toys R Us at the market, what you're saying is, I'm going to trust your judgment that you're going to get me the best price at this stock. So you want them to buy that stock, but you want them to buy it at the best price. So they may not buy it that same day you call. They may wait a day or something because they're going to be watching the market and they're going to try to get you the very best price to buy it at. Same thing as if you tell them to sell it at the market, they're going to be watching the market to try to sell it at the highest price possible. If you give them a limit order, you're telling them to buy and sell at a specific set price. So, you know, buy Toys R Us when it hits 25 bucks. So when they watch the market, as soon as Toys R Us is $25, that's when they buy it. If it never hits $25, they don't buy it, because you told them a specific price and they have to buy it at that price. Same thing with selling it. They have to sell it at the price you told them. If it never hits that price, they don't sell it. Okay. Your net proceeds are the profits that are made after the broker fees have been deducted. And that's not just the broker fees on that trade where you sold, it's also the broker fees on the original purchase. Oh, I forgot to put the purchase price in here. Sorry. Totally incomplete. Oh no, never mind, I lied. Capital gain took care of that. Okay, so your capital gain, which is your sell minus your purchase, right? So you've got your capital gain minus the fees that you paid when you bought the stock, and then minus the fees that you paid when you sell the stock. So you have to take all that into account. You can't just say, Woohoo, I made $100 on the stock. I bought stock and then I sold it for $100 more and I made $100. Woohoo! Well, if your broker fees were $30 and $30, that was $60 that you spent to buy and sell the stock. You didn't actually make $100. You made 40 because you have to take that 60 out. So your capital, your net proceeds take the capital gain and it takes out the fees. And then, of course, capital gain is sale minus purchase. That was your capital gain. Okay, and then your net loss is the same formula, but your capital gain would already be negative. Or actually, your capital gain might be positive, but if your fees were more than your gain, then you end up with a net loss. So, same formula, but you don't get a profit, you have a loss. All right, so if we're calculating our net gain or loss, we have to include our broker fees. So Lee makes 2 trades through his online discount broker, WeTrade. WeTrade charges $12 each. So $12 fee. And he made 2 trades, so times 2. Okay. His first purchase was for $34.56. And the second was $2,000. So how much he spent altogether was that $34.56 plus the $2,000 plus $24 in fees. That's the 12 times 2. So he spent $7,480. And I just, for some reason, added 3 and 2, and it was 7, except it's not 7, it's 5. It's 5,480 because 3 and 2 has always been 5. Except on Mondays it's 7, that's right. But it's only every 3rd Monday. Yeah. Okay, any questions on that one now that I've actually added properly? All right. So Adriana is purchasing $7,000 worth of stock. Her current portfolio is $11,567. Now we're going to look at this. Okay, so this particular company charges you fees based on the size of your portfolio, and that's actually pretty common. People that have more money in the in their portfolios, those companies make more money off of those people. So they get a discount, like they get a break on the fees because they want to have them keep putting more money in there. So if your portfolio is less than $250,000, you're in this row. And if you're more than $250,000, you're in this row. Adriana has $11,000. She is not in the big wigs, right? She's in this row. She's in the less than $250,000. Okay. Now, she purchased from a broker. So we have online, telephone, or broker. Well, she used a broker, so she's here. So we're actually in this box here where both the yellow and the green overlapped. So she pays the 5% commission, 0.5% commission, plus the online fee. So 0.5% commission plus online fee. That equals her total fee. .5%, if I'm going to turn that into a decimal, I go 2 decimal places this way. So it's going to be 0.005. And a commission is a percent of her purchase, so we multiply that times her $7,000 purchase. So far, okay? Now we have to find the online fee, and the online fee is $15. So we're going to have to add that $15 in. Okay. 0.005 times 7,000 is $35 plus her online fee. So she's paying $50 for this transaction. Here's where we get to the net proceeds finally. Okay, Erin purchased $23,510 worth of stock and paid a 1% fee. So on her buy, she paid that much. Okay. On her sell, she sold at $27,300 and paid a $21 flat fee. Okay. So now to figure out her net proceeds, I'm going to do her sell price minus her buying price. That gives me that capital gain, minus the buying fee and the selling fee. Okay, that's how we'll get her net proceeds. All right, we have the sell price, that's $27,300. We have the buying price, that's $23,510. We have the sell fee at 21, but we need to calculate this buying fee. We know it's 1%. We have to figure out what exactly is that number. Well, 1% is 0.01 because I moved the decimal over 2 places. So 23,510 times 0.01 is $235.10. I can see why she's decided to go with the discount broker later. That's really a lot of money. Okay, so I'm going to plug these in. Okay, any questions so far about plugging anything in? Okay, so her net proceeds are $3,533.90. Okay, and this differs from her capital gain, which would have been just the stock prices. So you can see there's a significant difference between the capital gain and the actual proceeds, your net proceeds. Just like there's a significant difference between your gross paycheck, your salary for your gross paycheck, and the actual paycheck that you bring home. Okay, so a stock split occurs for a couple different reasons, but the idea is that the number of outstanding shares of stock will change, but the price will also change so that the total value will always remain the same. So let's say I'm a company and I have 10 shares of stock outstanding. That's not that's nowhere even close to a realistic number, but let's just say that I only put out 10 shares of stock and they were worth $1 each. Okay, so the total value of those 10 shares would be $10. And I decided I wanted 20 shares of stock to exist. So now those 10 shares of stock would become 20 shares of stock, but I still need them to be worth $10. So now they're not worth $1 anymore, they're worth 50 cents. Or I could go the other way and if I wanted those 10 shares of stock to become 5 shares, they'd now be worth $2. So that the value of the 10 share, well, the 10 or 20 or 5, whichever way I split them, would always just stay $10. And there are reasons for this. If a company, let's say, is holding shares of stock in-house that they haven't actually released to the public for purchase yet, and maybe they have 100,000 shares of stock and they want to release a certain number, but they still want to hold a decent number in-house, they might institute a stock split so that they can turn all of the shares, like double the number of shares, and their 100,000 that they were holding in-house now becomes 200,000, and then they can release them. And they can release 100,000 and still have 100,000. Or maybe a company has, like, hold on one sec, 500,000 shares of stock out there in the world, but they're only worth like $1 each. And the company wants to make it look like their stock has gone up in value. If they do another stock split where they take those 500,000 shares that are worth $1 each and make them down to 100,000 shares, they're now worth $5 each. And so on paper, it looks like their stock increased from $1 to $5, and it makes them look like they're doing like really good. It's like an artificial inflation of the value of the stock. Yeah, what was your question, sweet? Oh, A for B. Yeah. So the outstanding shares are the number of shares that are issued from a company that they're able to sell. And when a company goes public, a corporation goes public to be able to sell stock, that number is set at that time. And then it can be changed. Stock splits can happen, but that's all very legal. It has to go through proper legal channels to happen. And then the market cap is the total value of all the outstanding shares. Now the market cap can change. Actually, the market cap does change every day, unless the price of the stock didn't change. So you take however many shares exist in the world, multiply it by the price per share, and that gives you your market cap. And the idea is that when you do a stock split, the market cap for that day doesn't change. So the number of shares changes, but the market cap will stay the same. Okay. In a traditional stock split, the number of shares goes up and the value goes down. Because at traditional stock splits, the most common stock split is when a company wants more shares of their stock to exist for whatever reason. So they want more shares available. So if they had 1 million out there in the world, now they want 2 million or 3 million out there in the world. And so the number goes up and the individual price goes down. Another reason that could happen is, let's say, well, you saw I looked at Netflix stock earlier and it's over $300 a share. When stock prices start to get too high for individual shares, it makes it hard for people to buy them. So a company might do a traditional stock split to increase the number of shares, and it brings the individual price down, and then more average Joe kind of people can afford to buy their stock, and the more people that are buying their stock, the better their stock is doing. And that's indicated as an A for B split. So it would, traditional or the other, which I'm going to talk about in a second, both are A for B. So you might have 2 for 1, a 2 for 1 split. P-L-I-T, okay, split, a 2 for 1 split. And what that means is that every share becomes 2 shares. So if there were 1 million, there's now 2 million. And these can be any numbers. They can be 2 for 1, they can be 4 for 3. So every 3 shares now becomes 4 shares. It doesn't have to be a perfectly even multiple. And there's different reasons that they do that too. Is when it goes the other way. This is the opposite. So the shares actually go down and the value goes up. And we're going to stop there. We'll get more into the actual math of the stock splits and stuff tomorrow.